What's going on? Alex here, and today we are experiencing the second live stream of the Efros Financial Power Hour. I'd like to welcome you guys. I appreciate it. I see you guys have been waiting, so we're going to get right down to it. But in the meantime, feel free to hit that notification bell, like the channel, subscribe, leave your comments down below, because while I'm going to be answering some Reddit questions, we're also going to be looking at answering your questions live. So make sure that you guys include your questions down below, and I'm going to try to answer them the best that I can. I don't know everything, but I'll give it the good old college try. That I promise you. And with that, we're going to turn our attention to the first Reddit question of the day. It's from Lightsaber5, and it talks about a text that this person received, and they're asking if it's legitimate. Let's take a look. We have this text here from irs.gov. Okay. And the message is, you have received and amended U.S. individual status amount of $638.12, which is available to claim. And it says that multiple taxpayers have had an error in the calculation of their tax. And to receive this amount, all you have to do is submit an application and complete your registration form here. Let's look at that URL. claim.tax.amended. Whatever that is, .us. Now, guys, I know we have some astute individuals here on the live stream with us. Does this look legit, or does this look more like a scam? Now, I bring this up because as tax professionals, we can weed out all of those little red flags that stand out to us because we see this every day. We understand how the IRS communicates. We know that they send letters in lieu of emails or texts or phone calls. We know that they don't contact you at odd hours of the day, and they tend to use spell check. Not always, but most of the time. And what we fail to consider sometimes is that our clients, who may be engineers, attorneys, doctors, they don't have the time in their day to read about all the various scams that are happening. So they may fall victim to some of these scams that may seem obvious to us as tax professionals. So we always have to keep that in mind, because these scammers know that when someone receives a notice from a taxing authority, be it the IRS or the states, they get intimidated immediately, they're frightened, they get emotional, and they want the issue to end as soon as possible. And they will typically do anything they can to resolve the matter. You might think that, hey, someone who's smart, someone who's astute is not going to fall for a scam like this. But I'd like to share with you a story from back when I worked for an investment firm where we managed about $300 million for clients. So these were astute individuals, typically professionals, and they needed to have an investment account of at least $300,000 for us to even manage their money. So this wasn't just some Joe Schmo off the street that we're talking about. And what happened was, I got a phone call from this client, and they say, hey, Alex, I just want to let you know the IRS called us last night, and they told us about $5,000 in taxes and penalties that we owed. Okay. And before I could even respond, the client goes, but don't worry about it. We argued them down to $3,000. Okay. And before I could chime in, the client goes on to say, and I have my wife on the way to CVS right now to pick up the Apple gift cards to pay the taxes and penalties that we owe in the amount of $3,000. Okay. Tax professionals might be rolling their eyes, slapping their foreheads at what they're hearing. But at that point, I was literally stunned. And I tell the client, look, call your wife right now and tell her to stop immediately with the purchase of the Apple gift cards and to come on home, because this was clearly not legitimate. All right. First of all, the IRS doesn't call you to resolve tax issues. They will send a letter in the mail. They don't email you either. And they certainly don't text. That was the first issue. The second issue was the phone call came in, according to the client, at 3 a.m., which, again, doesn't really look like it's coming from a source within the U.S. It probably came from abroad. Make sense? IRS agents don't work for a second over 5 p.m. They're not going to be working at 3 a.m. I promise you that. The other aspect that's alarming is that this person demanded payment in Apple gift cards. I'm just going to tell you right now, the IRS does not accept payment in Apple gift cards. What the scammers are relying on you to do is go to the store, get the cards with real cash, read them the numbers off the back, in which case the money disappears from your account, and that's it. Good luck trying to recover that, because you'll never see that money again. And this could be thousands of dollars that people are losing just for the fact that they don't want to deal with IRS. They're scared. And in this case, the client was ready to pay these amounts before we even heard about it as tax professionals, before we can even intervene. Because if they came to us up front, I would have said, this sounds crazy. Disregard it. Ignore it. Block that phone number. But here, we were able to intervene in time, and I told the client, look, you're good. Don't worry about it. The manner in which this has occurred tells me right from the beginning that it's a total scam and there's nothing to worry about. But these scams may not always arrive by phone or by a text, as we have in our example. You can actually get a letter in the mail from what looks like the IRS, in which case, what do you do then? Well, there's a good article here from Barry Ritholtz, and the subject is Beware Fake IRS Letter Scam. And you can see that there are some items outlined here in what is a typical IRS letter. Let me show you what a typical notice looks like. And let me make this a little easier to see. And you can see here that it'll have a notice type or description up at the top right of the first page typically. You'll have the tax year to which the issue pertains. You'll have the date on which the notice was issued, and a phone number here, which you should be able to Google and verify that is a real IRS phone number. Then the notice will tell you what the issues are. So if there was an amount due, if there's a refund, they'll go ahead and outline that for you right there. And moving along, they'll also tell you what differences they found in terms of what was on the return and how it was corrected by the IRS. You should be able to corroborate these amounts back to a return that was filed, because they could just make up these numbers if they're sending this letter as a scam. Again, people don't even read their tax returns when we file it for them, so they're certainly not going to read these letters in depth. Sometimes just by looking at the amounts that are outlined here, we know that this is not a legitimate notice. And you'll have all of the instructions in terms of how to contact the IRS and how to respond and so forth. That's what a real IRS letter tends to look like. What can happen, as we see here, is that scammers can fake that letter itself. But we will notice a few things that stand out. Firstly, the phone number will typically be a fake phone number to contact the IRS. They're not going to give you the real number. They're going to put some phone number that they own so that when you call them to resolve the issue, they'll be able to scam you at that point. Because they're not really waiting for you to respond in many cases to the letter itself. They want you to pick up the phone and call them to try to resolve the issue. Another thing to look out for is that these notices will ask you to make payments to IRS, not to the United States Treasury. If you look at the instructions for pretty much any tax form, if you're ever making a payment to the federal government, it's usually to, not in all cases, but usually to United States Treasury for federal income taxes. And this letter is asking you to make payment to IRS. And in the article, there's more details on this. And it says the tells for someone who has seen and reviewed actual CP 2000 notices are subtle but revealing. The single biggest red flag on the letter is that payment is requested to IRS, which is dead wrong. IRS can stand for Irving R. Smith, if you think about it, which is kind of clever on their part. But if they create a bank account, let's say, for Irving R. Smith, and you make a check out to IRS, they may be able to cash that check if a teller's not paying attention in some cases. So that's something to watch out for as well. Now, the phone number issue is also touched on in this article here, and it says that the customer service number is wrong as well. The IRS operates out of the easily memorized 800-829-1040. And that is a number that's ingrained in the brains of tax professionals. And the scam letter contains a different 800 number not affiliated with the Department of the Treasury or the Internal Revenue Service. How can you verify it? Google the phone number, because legitimate IRS phone numbers typically show up in Google, and you can trace it back to the irs.gov website, not irs.com, irs.gov. Then we see some shenanigans here regarding the payment address. It doesn't correspond to where the actual office is located. So obviously they don't want the real IRS getting the payment check. They want you to send that check to a false PO box that they set up to perpetuate the scam. And those are the things that stand out in terms of real paper notices that could show up that are fraudulent. Okay? Again, the phone number may be incorrect. They're asking you to make payment to an entity other than the United States Treasury. And importantly, they don't have the information from a return that you can corroborate. So just like on this notice, they have the shown on return amounts and the as corrected by IRS amounts, which can be another hint that the letter you're looking at is indeed not legitimate. Another thing I'll say on this is that if we go to this initial notice that we received here, you have received and, okay, that's a problem, amended, U.S. individual status amount. Again, these terms aren't really used by individuals residing in the United States. There's no such thing as a status amount for U.S. income tax purposes. So that's another hint right there. 638,12. Ooh, another swing and a miss. In the United States, we don't denote numbers that way. We use a period to denote where the cents start. Abroad, outside of the U.S., they typically will use a comma, so that's yet another tell. Okay? And the fact that this URL is completely ridiculous is another indication. Again, you might be surprised by how many people fall for scams like this. That's why they still exist. And this question came right from Reddit from today. So people are asking. Those are the ways in which you can protect yourself from scams. And also, if you have loved ones, especially if they're older individuals, they'd be more susceptible to this because these scams rely on individuals who are lonely. They live by themselves. They have no one to ask if it's legitimate or not. And they could fall victim to some of these scams. So elderly individuals sometimes are targeted by these scammers because they don't have the ability or capacity to ask someone who's close to them for help. All right, so a few things to watch out for. And hopefully Lightsaber 5, this is helpful in terms of determining that this is quite obviously a scam. Block that text, phone number, or email, whatever it is, and don't worry about it. The IRS does not contact you in this way. And if you guys are watching and this is helpful, you're enjoying yourself, you're getting value, hit that like button, subscribe to the channel, hit that notification bell so you're notified when these live streams happen. And there will be more uploads coming as well. With that, we're going to move on to the next Reddit question of the day, which deals with tax relief companies. And the question goes as follows. It's from K Travel Media. Hi, I was just wondering if these companies are worth paying. I found the highest rated one, Precision Tax, but they want to charge me $6,000. I was wondering if it's worth it or if I could do it on my own. I just know nothing about what to do. Any advice is helpful. When I was studying for the EA exam, I wondered, how is it that I used to see commercials for companies that can eliminate your tax debt or negotiate your tax debt, settle your tax debt? How does that work? Because if someone owes $100,000 to the IRS, how is it that they can magically make those amounts disappear? And there were two predominant tax relief companies that used to advertise when I would watch TV when I stayed home from school and I was sick. And those were Tax Masters and the Ronnie Lynn Deutsch Law Firm, or the Ronnie Deutsch Law Firm. And they would specialize in tax relief, which means that they would get a client who has a tax debt of, let's say, $100,000, and they would claim that if you pay us our fee, we'll reduce it or eliminate the debt for pennies on the dollar, and would call it a day. When I was studying for the EA exam, I wondered, how do they do this? And I had an 800-page book. It was the Passkey study guide for the EA exams. And once I made it through that entire book, I realized there really was no magic bullet to how these companies functioned, right? There are some ways to mitigate tax liabilities, offering compromise, currently not collectible status, all those different things, but there's no magic bullet here. That's the point. And in going back and researching these companies, I found out that Tax Masters was closed down and Ronnie Lynn Deutsch was closed down as well. And if you Google Tax Masters, you can see that they were shut down here. They were slapped with a $195 million fraud judgment. Upon hearing that, it became obvious to me that this whole tax resolution field is filled with scam artists, quite simply. And what they'll do is they'll say, oh yeah, we're gonna help you file for an offer in compromise, which the IRS has beautiful information on their website. And if you read the information, you'll find out that while some people are eligible to reduce the total amount they owe, the IRS is not giving out freebies here. This isn't a way to forgive everybody's tax debt because you may not be eligible for an offer in compromise. And I would venture to say that a vast majority of individuals who apply for an offer in compromise don't qualify, maybe 95%. So what these tax relief companies do is they'll say, hey, we will file an offer in compromise on your behalf. You pay us $6,000, and then whatever happens, happens. Because they're not guaranteeing that your tax debt is going to go away. No. You sign on with them, and I don't know about precision tax by itself, so I want to preface that statement. But typically, with these companies, you pay an upfront fee, and they'll do the best they can. But what can happen is if you owe $100,000 to IRS and you pay one of these companies to relieve your tax debt, you may end up owing the IRS whatever you owed, plus additional penalties because of the time delay, plus additional interest on top of that, and the fee that you paid for this company to file an offer in compromise on your behalf that they knew full well you wouldn't qualify for. Offer in compromise has very stringent requirements, and it's not for everybody. They're basically only relieving your tax debt if you don't have the ability to pay it back now or in the future. So in many cases, it requires financial disclosure. You have to make the case to the IRS that you're absolutely destitute and expected to be that way for the next number of years. That's not an easy hurdle to get over. And assuming that they're filing the offer in compromise using legitimate information and they're just not making up information out of the blue, you're facing an uphill battle to actually get tax relief. So far, I have not found any tax relief company that is legitimate. When I help clients with tax resolution at our firm, they typically come from these places and they owe the tax debt that they had before, plus whatever they lost to the company that was supposedly going to help them. All right. Not a good outcome for pretty much anybody involved except the tax resolution company. And in this case, it's not something I would recommend clients to get into unless you do your research. Again, I don't know about precision tax itself or how they function. A lot of these companies either don't have a guarantee, and if they do have a guarantee, then there's some fly-by-night operation that you call the phone number one day and there's nobody there. Okay? A few things there to watch out for. Again, guys, drop your questions in the comments box down below. Don't be shy. I don't bite. While we move on to the next question of the day, and this is also from Reddit. The subject here is made $150,000 in the short term, need help with it to find out if I need to make estimated payments. All right. I am a worker with a salary of around $60,000 per year. I've never owed taxes in my life or in previous years. This year, I made a small investment that made me a realized short-term capital profit of $150,000. I love that the proper terminology is being used. It lights up my day. I was trying to learn and read about taxes and how much I would owe on this and came across estimated taxes. Will this apply to me, or do I just pay taxes on this next year when I file my taxes? I don't want to be hit with an underpayment penalty. I tried to search around and tried calling the IRS about this question, but can't seem to find any answers nor get a hold of them. That's the key right there. The IRS used to make you wait a long time to get on hold. Now, to even get on hold is a gift. Maybe 1 out of every 30 calls even gets on hold to then wait 4 hours. That's where we are. But back to the question. So this person had a salary of $60,000 and they have a short-term gain of $150,000. Now, the question is, do they have to pay estimated payments throughout the year? And let's assume, since this question came 6 hours ago, that we're talking about August 31st as the date? The answer to this question is a bit more complicated than you might think. Now, by default, when you have income that you receive throughout the year, especially if it's uneven, you do need to make estimated income tax payments on the payment deadline. So for federal tax purposes, you're looking at April 15th, June 15th, September 15th, and January 15th of the next year. So for tax year 2022, you'd want to make those payments by April 15th, 2022, June 15th, September 15th, and January 15th, 2023. It still counts for 2022 if you pay it by that date. And this is typically applicable when you're receiving income that is not subject to withholding. So any types of gains, interest, dividends, rental income, you would want to stay on top of those estimated payments. But the tax code does include a provision where you can avoid the penalties and interest on the additional income based on your prior year situation and how it relates to the current year. Let me explain. Pulling up the good old tax software, we have a 2021 Form 1040, and the 2022 software isn't available yet, so we're going to focus on this one for now. And here we have $100,000 in income. We're going to change that to $60,000 just to really align with the situation at hand. Okay. Alrighty. So we see here that the total amount due would be $6,193. Again, we're assuming no withholdings. And if we go to the penalties and interest, we're going to make sure those are turned on. Let's assume we're filing this return by 4/15/2022. Again, this is a 2021 return. And here's where it can get interesting. So now we're going to add the short-term capital gains in here of $150,000. And by the way, what sort of investment was this? That's what I'm curious about. So for date acquired, we're going to put 2021. All right. And this is generalizable for every year, so you don't have to drive yourself crazy. The important thing is that this is short term, and we got 150,000. Let's see how that affects the return. On the Schedule D, we should see 150,000 short term. Beautiful thing. Now, if we go to the 1040, you'll see that the total tax amount has increased, but now we have an estimated tax penalty of $797. The reason being is that there was income for which there were no withholdings. All right. So how do we address this situation? Now, the safe harbor is as follows. It's a bit complex to explain, but as long as your withholdings in the current tax year exceeded your total tax from the prior year, then you will qualify for the safe harbor to avoid the penalty for estimated tax payments that aren't paid on time. What do I mean by that? All right, let's go to the prior tax year, and I'll show you here that if we assume that, let's say, the prior year AGI is 100,000, there's basically a 150,000 threshold associated with that. Let's not get too crazy for now, but let's say that the total 2020 tax liability was $10,000 at the federal level. Okay? So in this case, if our withholding from wages exceeded $10,000 in the current year, so we're pretending this was 2020, and in 2021, if our withholdings exceeded $10,000 at the federal level, then we have the ability to avoid making estimated payments and just pay the taxes when the return is filed by April 15th, 2022, if we're talking about 2021. All right, this is a beautiful thing. And not Ben 101, I see your comment here. If income is over 150,000, the safe harbor is 110%. Absolutely astute observation. I'm trying to keep it simple here, but clearly you're ahead of the game. But that's important to note in that if it's AGI is over 150,000, then the safe harbor is 110%. I don't want to get that much in depth, but not Ben, very astute observation. In this case, we're going to keep it at 100,000, and let's look at how this affects the return. And we look at the 1040 again. Now, there's still a tax penalty. How do we get around this? Well, if we look at the withholdings, let's enter $10,001 as the withholding amount for federal income tax purposes. And what do we get? We get the penalty eliminated. All right, that's the safe harbor at work, because the amount withheld in the current tax year exceeded the total tax from the last year. Okay, so that's one way to qualify for the safe harbor. The other way is if you have a certain amount of withholdings and you make timely estimated tax payments in this case 2021, then you can also qualify for the safe harbor. So this allows for the savings on the tax penalties when you have an income year that's, let's say, 100,000, then you have a high income year that's, let's say, 1 million. You can avoid being hammered by the tax penalties in that case by making sure that you pay in at least the total tax amount from last year in withholdings and timely estimated payments. That's how you can get into that threshold and take advantage of it in terms of the safe harbor. Now, this can be a useful tool because you can hold on to the funds for a lot longer throughout the year, meaning that instead of paying, let's say, $25,000 each quarter, you can actually delay payment of the tax until you file the return and not have any penalties or interest whatsoever. So this is the safe harbor. And to touch on Not Ben's point, if we were to go back to 2020 in this case and change the total AGI amount to $150,001, what happens? Let's take a look. In this case, there should be some penalty, okay? Because if your AGI is over 150,000 in the prior year, then you need 110% or 1.1 in terms of the amount withheld. What do I mean by that? So we had 10,000 in the last year as the total tax, all right? And then we multiply that not by 1.0, but 1.1 to signify 110%. And what do we get? We get $11,000. That gives us the baseline for 2021 in this scenario for how much must be withheld and or paid through timely estimated tax payments. Now let's take a look at where we are. And if we go back here and we say that we withheld a little bit more than that, $11,001, what do you guys think is going to happen to the penalties? Penalties or no penalties? Vote down below, but I'm going to show you anyhow. And if you go down, you'll see that there are no penalties because, again, we've qualified for the safe harbor in this situation when AGI has exceeded 150,000 in the prior year. So you use 1.1 or 110% as opposed to 1.0 or 100% if the prior year AGI is less than $150,000. All right. Let's go back to the question. This year, I made a short-term realized profit of $150,000. Will this apply to me, or do I pay taxes next year in terms of estimated tax payments? Well, going back, if the current year withholdings are expected to exceed the prior year total tax, given the 100 or 110% thresholds that we discussed, then you do not have to make estimated tax payments if you qualify for the safe harbor for the current year based on the prior year. Otherwise, if let's say you had a high income year last year and you have a lower income amount this year, then you may need to put together some projections to estimate those estimated payments. All right. So that's a little bit about the safe harbor at work. Remember, there's two different thresholds depending on whether your prior year adjusted gross income, or AGI, which is found here on Form 1040, was above or below 150,000. Now, if it's below, you use 100% of the prior year total tax. And the line that I'm referring to there is right here on line 24. The line numbers can change sometimes from year to year, but you're looking at that total tax amount as your guide. Now, it does get a little bit more complicated than that, but on a very basic level, that's how you can avoid issues in many cases by qualifying for that safe harbor. All right, so we have some more questions here. Let me zoom in on this because I am kind of a blind person, really, even after the glasses are taken into account. Let's bring this up. All right, so Not Ben coming in with the amazing questions as usual. And can he just qualify to make a payment on January 15th of 2023 if he doesn't qualify for the safe harbor? Another great point. So if we go deeper into the world of estimated tax payments and penalties and how all of this works, there is what's known as the annualized income method. Okay. And what that allows you to do is deal with estimated payments in tax years where income is lumpy. All right. So to illustrate this point a bit more, we'll just put together a beautiful spreadsheet for you guys because you know how much I love spreadsheets. You have income that looks like this for the salary portion. And then in quarter 3, because we're in August right now, we'll call it Q3, the income jumps. All right. And then we go back to this. Okay. So there is a way on the tax return to signify that, hey, I did receive so much income throughout the year, but there was a lot in Q3, so that amount can be paid by September 15th. So essentially, you may avoid paying estimated payments in Q1 by April 15th. Don't have to, because you didn't get the income yet, right? Then you can avoid paying the estimated taxes by June 15th because, again, you didn't receive the income yet. But in Q3, you would have received the income, and by September 15th, the estimated payments will kick in. And the way it works is that essentially it's going to be annualized and the Q4 payment will be higher as well. But that is how the estimated payments work. And if you annualize the income, you'll see that the form, if I remember correctly, is 2210. Let's see if I got this right. I love live streams because you never know. And let's pull up the form here, which is form 2210. I'm going from memory, guys. Bear with me. And let's look at the annualized method. All right, so let's see. Here it is. Look at this beauty. Aren't you jealous of your tax preparer that they get to play with this form? I don't think so. But anyway, you get the annualized income installment method here laid out. And it has the dates on which the income is received. And you can see here that it asks you for the beginning of the year till the end of March, beginning of the year till the end of May, beginning of the year till the end of August, and the end of the year. Why is this significant? Is because the payment for this quarter needs to be paid by April 15th, then June 15th. So you see, it kind of makes sense from that perspective. And here are the calculations. So what ends up happening is that we file essentially 4 miniature tax returns. We have to break up the year into the time period for the first quarter, the time period for the first 2 quarters, the time period for the first 3 quarters, and so forth. So this is more intensive from a workload perspective, and we have to build clients for this stuff. But this is the way in which you can address the situation of lumpy income or uneven income throughout the year. And to answer your question now, Ben, in this case, assuming this person received that capital gain today on August 31st, 2022, they would, by referencing the 2210 form, have to include that right here in column C. And that would increase the payment that they would make on September 15th and also January 15th. All right. So that's how that plays out. There is a way to address this. It's not very simple to get there, but if you compute your penalties with this form in mind, you may see significant penalties that you calculated without using the annualized method completely disappear once you incorporate the annualized method. All right. So if you're sticking around, if this is helpful, if you're enjoying yourself, like the video, subscribe to the channel, and hit that notification bell to be notified of future videos. All right. Keep the questions coming. I love the questions for you guys. I'd much rather answer your questions live than go through the Reddit ones, but we're going to do what we can here. All right. Now, Andrew asks an interesting question that's near and dear to my heart, and that is, what is your favorite provision in the tax code? I've been doing this long enough to have seen a wide variety of code sections, and it's usually a joke that tax preparers will say amongst each other, like, oh, you really love that tax provision, don't you? Oh, that 1245, oh, that 1250, you must really like it. But I do have a favorite code section, actually, that I came across as I was a student in my MBA program. And I thought it was really clever on the part of Congress to think this up. And that code section is good old, and some of you may already know, Internal Revenue Code Section 61. It just rolls off the tongue, doesn't it? When you hear it, it just lights up your day. I know it lights up mine. And this is the code section that defines gross income. Because if we look at our tax return here, we'll see that there are some amounts that are included in income here. So wages, salaries, tips, interest, dividends, IRA distributions, pensions, Social Security benefits, capital gains. Where does all of this come from? How do we determine what's taxable and what isn't? Well, the Internal Revenue Code dealt with that in a very interesting way because they didn't take the position that they're going to define all of the different aspects of income that one can receive. They didn't say that, you know what, let's list all of the different income amounts and hope we cover everything. Because what is the limitation of that? They knew that in the future, there's going to be new methods of earning income. There are going to be new financial vehicles that are created. There are going to be new aspects of finance, such as cryptocurrency and all of these different things that were not conceptualized when the tax code was written. And what they did was they said, look, we're not going to try to tell taxpayers what is income. We're going to say everything is income until and unless we say it isn't, right? So the default treatment for any amount that you receive is that it's taxable unless you can point to a code section that specifically excludes that income. So let's read. Except as provided otherwise in the subtitle, gross income includes all income from whatever source derived. How awesome is that? Think about it. When cryptocurrency came along, nobody knew about it. Nobody could fathom that this could be a new financial vehicle that essentially replaces money in some cases. But Congress didn't have to worry about rushing to update the tax code to say, oh, wait, your cryptocurrency gains, those are taxable. Because of Code Section 61. It says gross income means all income from whatever source derived. And it even gives you a list, included but not limited to, and gives you all of these different amounts just as a guide. They went out of their way to list them. They didn't have to. But what that means is as soon as cryptocurrency came into existence, it was already taxable. And Congress did not have to even grab their pens to update any sort of code because there's no provision in tax code that says it isn't taxable, which means that it's automatically taxable. So what are some provisions that exist which allow for income not to be taxable? Well, gifts aren't taxable, okay? Life insurance proceeds received when someone passes away, they're not taxable. You have some distributions that are affected because of divorce, they're not taxable. Tax-exempt income at the federal level, typically municipal bond interest, not taxable. All of those arise from specific code sections that say this is not taxable, this is not taxable, that's not taxable. And that is the only time where anything is excluded, all right? Gifts aren't taxable. Why? Because the tax code says they aren't. And some amounts that you receive when someone passes away, in terms of inheritance, they're also non-taxable. Why? Because the code specifically excludes it. Now, we're not going to run through all the different code sections, but if you look hard enough, you will find that any income that is not taxable is that way because the Internal Revenue Code says so. Make sense? All right. Amazing question, Andrew. I know you've been coming here since day one. I appreciate you. Thank you so much for tuning in. All right, we've got time for probably one more question, and that's from Lewis. Thank you for your question. So let's take a look. What do you do when a new client has super messy books? Do you turn them away? This is wonderful because of how timely it is. Efros Financial has officially launched accounting and bookkeeping services, and I can tell you that there are a lot of clients out there that need help with accounting and bookkeeping because unlike many other aspects of finance, accounting and bookkeeping is not regulated at all. There's not a single law, a single provision that says who can and cannot do accounting and bookkeeping, which is a little bit crazy if you ask me, because if you want to shampoo a poodle in Los Angeles, you need a license. But if you want to do accounting and bookkeeping for multi-million-dollar entities with complex withholdings and taxes and all these sales tax amounts that they have to deal with, you need zero qualifications, nothing. People wake up one day and say, I'm a bookkeeper, I'm an accountant, and start charging people for their services. Now, what happens is that at some point it comes time to prepare the tax returns. And that's where we get the books that this accountant bookkeeper has prepared. And I can't tell you how many disasters we find. Now, clients trying to do their own books, that's one thing, right? We get the box of receipts, we get the Excel spreadsheet from hell, we get the QuickBooks, that's a complete abomination. More videos on that coming up. But sometimes you can't even make odds or ends of the situation. It makes for a difficult conversation to have with new tax clients to tell them that, hey, you're bringing on a mess and we got to charge you to fix that mess. In addition to all the bookkeeping and accounting fees you already paid the so-called bookkeeper. To answer the question, it really depends on the extent of the damage and the willingness that the client has in terms of fixing it. All right? Because truth be told, a lot of clients have already paid for the accounting and bookkeeping and they already try to pay bottom dollar for the cheapest accountant bookkeeper they possibly could get just so they feel like something's being done. And when we tell them that, hey, we have to start from scratch here. There's nothing here that we can use, and we have to basically get your bank information, export it, go transaction by transaction, and essentially throw everything away that this bookkeeper accountant has done because it's going to take us more work to fix it than it will to start fresh. And clients don't want to hear that, especially if they're kind of coupon clipping in terms of the accountant bookkeeper that they took on. And in that case, you'll find that that client is not even going to move forward. They're going to say, look, I don't want to pay $2,500. I don't want to pay $5,000 or $10,000 to have my books fixed. And they'll look elsewhere, which is perfectly fine. So we don't even have to turn them away. They'll turn themselves away if it's bad enough. Then there's another class of clients where they worked with an accountant bookkeeper in the past and their books are still somehow atrocious. They paid a qualified person. This was one example, a CPA with more credentials than I can even list. I mean, this person had alphabet soup. I don't know how they could create a business card. It would have to be a business scroll for all of the acronyms that they have after their name. And the books were a complete disaster. Excel spreadsheets with things hidden and crossed out and strike throughs and all these different things. And we couldn't even get to the point where we'd be comfortable with those financials. So in some cases, we turn away the client because the amount of work it's going to take to clean up and the expense involved with it and the time is just too much. Now, they need help. Someone's going to be out there to help them, but we have to focus on getting the work done and then moving on to the next project. So unless they're willing to put up a big retainer and put up with a substantial fee, that's probably not a good fit to begin with. The other thing is that you may discover in fixing the books that they need to then amend prior year tax returns and or file those returns if they haven't been filed. So a project that you thought was this big just to fix the books turns into this and this and this. And the client gets the impression that you're trying to gouge them because, wait a minute, you told me the fee to clean up the books was $5,000, but now you're asking me for $5,000 more. Well, we also discovered that your tax returns were filed incorrectly in the prior years. And then you get into this battle where the client says, look, I don't want to fix prior years. I just want to fix it moving forward. It creates a shaky foundation in terms of that relationship because the numbers that we're starting with are not solid, so we don't have comfort with them. And then we have to file tax returns based on those numbers that we're rolling forward that are most likely incorrect. That's not a comfortable situation to be in. So in those cases, unfortunately, we have to turn away those clients. Now, where they end up going, I don't know, but they have to find someone who's willing to do that work and not charge an enormous amount, which puts them back in the situation in which they started, where an unqualified person essentially is doing their books. Now, this is millions of dollars of revenue that could be misclassified or underreported, understated. And it's really sad that people get into this situation because some of them are well-meaning and they try their best. They hired somebody who's supposed to be a professional, but they didn't get the job done right. And then they're essentially screwed in many cases. But there are some clients that come along and say, hey, I did the books myself. I did the best I can. Take a look at them. Let me know. And in very many cases, we may have to start over with those clients, but we're more than happy to take them on because we can be assured of the numbers that we're starting with. At the very least, we're comfortable that they're not pulling some sort of shenanigans, trying to underreport income, trying to hide income, anything like that. They're not doing anything illegal. They're well-meaning. There's not that much cleanup, just some, right? And we could tell them a reasonable fee, like, hey, this might be $1,000, it might be $2,500, but then you're on board with us, and we can make sure it's done right from there on. And those are great relationships because when you help them clean up the books, they get a tremendous amount of faith in you and confidence and trust. And then from there, it's smooth sailing because you're doing their books on a monthly basis. And tax season is that much less stressful because the numbers are already taken care of. All right. So with that, this wraps up our hour, guys. Hopefully this was educational and helpful. Hopefully you guys have value out of this. Again, we're going to be doing this every Wednesday. 7 p.m. Pacific time, 10 p.m. Eastern time. It's going to be a live stream. And we've got some more good stuff in the works for you. Believe me. Hit that notification bell so that YouTube tells you that we're live streaming. Mark your calendars. Bring your friends. Share the video. Like, subscribe. Keep your wonderful comments coming because as you can see, we are addressing the questions as they come in. And with that, as always, hopefully this was helpful. Thanks for watching.